Hello again, Mike Zimov here from Physician Banks, and I wanted to introduce you to Emil. Did I say that correctly? Emil?
Emil, yes.
Emil, yes, and we're going to kind of have a no fluff, all content conversation here to help you guys kind of prepare and understand the inner workings of this mortgage beast that you get bombarded with whenever you go under the knife with your loan officers here. So we've got Emil here, and oftentimes you guys are you guys are skilled in something entirely different than finance and how things work on this side of things. And so what our conversation is going to do is hopefully kind of lay some clarity around a lot of the jargon that we have within the industry, and give you a really good platform to talk to Emil when the time is right, and kind of have some of these basic questions out of the way so that you guys can have a more fruitful conversation when it's time. So without further ado, Emil, kind of tell us a little bit about yourself and a little bit about your background and kind of how long you've been working with physicians. And then after that, we'll kind of get into your product guidelines.
Excellent. Thanks, Mark. Mike, I appreciate the invitation. My name is Emil Zralov. I'm with Lake Michigan Credit Union, otherwise known as LMCU. I've been in the lending business for the last 25 years. I've worked with physicians for quite some time, but for the last 7 years, I've been with Lake Michigan Credit Union, who has pioneered this physician loan program, and we probably the best in class. We offer a zero down mortgage for up to $750,000 of purchase price, and then 5% down up to $1 million, 10% up to 1.25, and 20% down for anything north of that. Our program, as far as eligible physicians, are MDs, DOs, dentists, orthodontists, DPMs, and as well nurse anesthetists as a new addition to our program. We offer very flexible terms. We like to work with residents and even physicians into their careers. However, the most recommended product for resident physicians is usually the 7-year ARM. What that does is that gives you the flexibility. First, it gives you a lower payment than the 30-year fixed,
right,
which is important on a resident's.
Right.
Yep, on a resident's salary, it's very important to be payment conscious. And also gives you the flexibility that if you want to stick around for a residency or you end up accepting a position in that area, it gives you the opportunity to stay in that house for a little bit of time without the rate adjusting on you while you shop for your new home once you become an attending physician.
Awesome.
We do allow you to we allow you to close on your mortgage up to 60 days before your contract start date. We will qualify you off your contract salary, not necessarily what you're making today. Our loans are zero down with no PMI. For those of you that aren't aware, PMI is an insurance premium that borrowers who put less than 20% down have to pay to protect the lender in the event of a default on the mortgage. So we waive that requirement for our physician borrowers.
That's huge. Just kind of with traditional financing, most banks require 20% down before you can have the option of not paying that. So private mortgage insurance, if you've ever heard of traditional financing, private mortgage insurance is definitely on there if you're putting less than 20% down. With physician mortgage, specifically your physician mortgage, that's not the case. Before we get too much into the nitty gritty, can you kind of go over like what are the loan limits and down payment requirements over 750?
So over 750 up to $1 million, our required down payment is 5%. But the best part about Lake Michigan Credit Union is this is a portfolio product. What that means is we don't have to follow any agency rules like Fannie Mae or Freddie Mac. this is a portfolio product. And if we are slightly outside of the guideline, let's say the house is 765 or 795 instead of the 750 limit for the zero down, I can go to my credit committee and support my request with some compensating factors, and we can go above the guideline when necessary.
Okay, cool. I don't know that we can stress how amazing that is, but as far as us industry guys like that, when you're going through the financial oscopy of an underwriter and kind of what the documentation trail that they want, and the fact that you've got that flexibility is amazing. And that really does open up a lot of doors for our doctors if they don't necessarily fit right inside the mold that you've carved out for them. So
exactly.
That's really cool.
Probably one of the biggest benefits of this loan and why the need for the doctor loan was created from the beginning was most doctors graduate, or most medical students graduate with, several $100,000 of student loan payments. And we do not calculate those payments in the debt ratios. For conventional, you have to have a 3-year proof of deferral.
Right.
In order not to be counted in the qualification ratios. So with us, as long as you are in a residency, we do not include those payments at all in your ratios.
And that's really cool, because back in my day, and it's been nearly a decade since I've lent on a physician mortgage, but back in my day, like when we had somebody that had forbearance come across our desk, we either had to document, to your point, that they weren't going to make that payment over the next 12 months, which typically they wouldn't have an option to reevaluate that until sometime in the midsummer anyway. And so they certainly weren't going proactively to take care of that now, or they had to refinance or get income-based repayment. So that we could document a payment on that. And again, that was an issue because then they had to get their tax returns and all that fun stuff. So the fact that you guys have just kind of waved it all together is pretty cool. And that really does make the process a lot more streamlined.
Yeah, well, the spirit of the program is to make it easy for someone that's going to relocate. For the next 3 or 4 years, we'd hate to see you throw all that money out on rent. That's why the program was created. This gives you an opportunity, to build some equity, not throw money out the window on rent, and give you, we realize what you guys go through, especially for the first few weeks of your residencies. And we want to make the transition as smooth as possible. Our documentation requirements are very minimal. We ask for your residency contract, your, diploma or educational transcripts from your medical program to see that you've completed it. And we're on our way. We are a member-based organization. We are a credit union. So you do have to open an account, and a direct deposit is required with us. However, this is probably, with the interest rates we pay on our checking accounts, that's never been a challenge.
Right.
Our max checking account pays 3% on our checking account up to the first $15,000. And that seems to help out quite a bit.
Can we talk for a moment about, and again, these guidelines change, and at the time of the recording, he's given you Emil's given you the guidelines of what this program looks like. But let's say some of our guys are coming out of residency or coming out of fellowship. How do you guys handle the employment contracts when they're coming out of residency? So, like, say, for example, some of our guys are going to go and get involved with a physician group. And with a physician group, oftentimes they're going to be 1099 contractors. And at least with many banks, And traditionally, like with a conventional mortgage, you'll have to have 2 years worth of self-employment to qualify. Is that something that you guys would review on a exception basis, or is that pretty much, do you have to adhere to those guidelines too?
So with 1099, we see that very common today with dentists. Dentists are hired on a 1099 contract. What we look for in those employment agreements is the minimum number of days you're required to work and the minimum daily payment. So most dental contracts have a $500 or $600 daily minimum and a 4 or 5 day minimum work week. So we
You'll
use
qualify
that.
based off the contract?
Oh, 100%, 100%.
Wow.
And, and earlier in the video, I mentioned that we allow you to start up to 60 days prior to, we allow you to close for up to 60 days prior to your start date. We've had situations in very competitive areas where a house comes up and it's gone the next minute. We've had it where we're 90 or 120 days from your employment start date. But if that contract is signed and there's no contingencies, and when I say contingencies for employment agreements, it's usually things like drug tests and,
right,
getting whatever other
medical license in that state.
Correct. So as long as those contingencies are cleared, we allow you to close. We had a situation in Northern Michigan recently where it was a young couple and she just got her first attending contract with a private practice. And, houses in Traverse City, the minute they get listed, there's a line of people, making offers on them. And we were able to secure that property for them because we didn't have to wait for them, 4 months before this particular borrower started her job. She was able to close because they had some compensating factors, such as a spouse who had a current income, as well as some reserves to make the payments until the first payment's due.
I'm actually glad that you brought up reserves, because that kind of leads me into the next section here. And reserves, if you wouldn't mind, let's go ahead and define reserves for our audience, because that's another word that gets thrown around that people might be left like thinking, well, what does that mean?
Absolutely. So reserves are funds left over after your down payment and closing costs, or in this case, with no down payment, after you've paid your closing costs and your startup costs. Reserves are money left over in the account after that. On our doctor loans, we do not have a reserve requirement. The only time reserves go into are taken into consideration is when we need them as a compensating factor to make some kind of exception to the regular guideline.
Or to your earlier point, when they are going to close on a house 120 days before they start, and there's going to be 1 or 2 months due within that time period.
Correct.
Yeah. So it's a multiplier of your monthly payment. So if your monthly payment is $2,000 a month, then 1 month reserve is $2,000. Is that correct?
Correct.
Yeah.
Correct.
So that's huge, because traditionally, and with a lot of banks, what you'll find is they require, like, after you've paid escrows, you've paid your closing costs, you've shelled out all this money to get to the closing table. Many banks will require you to have another 2 months worth of reserve, 2 to 6 months worth of reserve.
2 to 6. I was going to say, I know some of my competitors require 6 months, and reserves can be gifted, but when you're talking about, first of all, not everybody, has that luxury of family gifting them money for the down payment, closing costs, or reserves. And, but coming out of school where you're, loading up on student loan debt and, just to financially survive through school, it's very hard for people to save money. And this is why, we believe in our doctors, if they've gone through the education and they've made it this far, we're not looking for reserves. We know that they're accountable for the payment. We know that they're responsible enough to go through the education and the training to get to this point. And therefore, we don't have a reserve requirement.
That's really clutch. And if you are established and you've been doing this for a while, then like having you have a retirement account and you can use a portion of that. That's generally not the issue, but that's not generally who your primary customer is. Your primary customer is someone that will eventually make that kind of money, but currently does not have that kind of money sitting in the bank account. So that's really really cool and a great feature to your overall loan. So yeah, so I think overall, I mean, we've touched on really all the questions that I have. Is there anything else that you'd like to add? Is there any maybe some stumbling steps that you've kind of come across that you want doctors to prepare for before applying with you, or I guess kind of walk us through like at what point is a good point for them to contact you and start to move forward?
The minute they're matched to a program and receive a contract,
Okay.
we don't have to have the fully executed contract to start the application process and get them a pre-approval, but we will need that contract executed prior to closing. But the best time to start is probably as soon as they get their match and they know what they're going to make and get a draft of the contract and they know that they're going to accept that position. That's a good time for us to start. Oftentimes we run into like some type of minute credit snag, and it could be something like a loan that came out of deferment.
Oh, right.
And the borrower wasn't aware. But when we run that initial credit report, that gives us the opportunity to address that issue prior to going to contract on a home. Right. So, the best thing to do is get stuck, as soon as you know where you match, or as soon as you get your employment agreement, let's start the application. Let's get your credit report pulled. Let's look at all the different things, so they don't become pitfalls during the process.
That's an excellent point, because I think what a lot of people see you as is I mean, they might be anxious but they don't necessarily understand that you, Emil, are in their corner and you are their loan officer. You are not the underwriter. You're kind of more like the attorney that's advocating on their behalf. And so the fact that getting a pre-qualification from you and eventually pre-approval and going through those steps early on is in their best interest, so that you have all the pieces and you could advise them like, listen, don't make any large deposits into your bank account, or if you do, then make sure that we know exactly where it's coming from. And like there's these different things that kind of jump up and during the qualification process that would be very avoidable if somebody had a conversation very early on.
Absolutely. And it's a first, even though these people have gone through, their bachelor's education, their graduate education, this is in most cases, their first time buyers. And that's what we're here for. We're here to coach you through the process, advocate on your behalf, and like I said, we're a portfolio lender with these products. What that means is that we use our deposit base to fund these loans. And if it's a make sense situation, I mean, recently I had somebody with a 660 credit score get approved because, it was a circumstance where the borrower had no idea and their loans came out of deferral. When a loan comes out of deferral, a student loan, they don't report a 30 or a 60-day late. It reports as a 90-day late.
Yep.
So you can only imagine what that can do to a credit score. I mean, it tanks it.
That happened to me. That absolutely happened to me. I didn't learn about it until I was fresh out of college, looking to get my first car from a car dealership, and I came back with like a 480 credit score because I wasn't aware that my loan came out of deferment and I had to start paying it. So,
and in this circumstance, in this situation, I was able to fill out my credit committee request and petition the credit committee for an exception because the rest of the borrower's credit was spotless. Right. And it's just one of these things where these we understand how busy you guys are. We understand, how important what you're studying and, what you're doing is. And sometimes these things slip through the cracks. and we're not going to punish you for it if everything else looks and fits the character of our borrower profile.
That's really crucial. I mean, that's clutch because, like you said, I mean, there's a lot of places that they take one look. Okay, it's this, maybe one of these corners are missing here, and it won't fit into this hole, and so denied, and then that opens up all these different issues that make it really, really tough to kind of get reapproved somewhere else. So the fact that you guys have that kind of flexibility is quite amazing. So
Yeah.
um,
We
anything else?
also offer our doctor loan for construction as well.
Oh,
So, yep. So physicians, and this isn't going to probably not going to appeal to residents,
right.
but people graduating from fellowship and going into their attending contract, if they wanted to do a new construction home, new construction comes in, two different ways. There are some of the national builders that'll ask you for a deposit and build the house and have you close at the end. We're happy to pre-approve you for those situations under the doctor loan terms as well. And then there are certain builders that require construction draw loans. And we offer a construction draw loan as well for our physicians in Michigan and in Florida. And those draw loans are where you put, you're closing on the land and hiring a builder to build it for you. And you pay incremental draws based on the outstanding construction line until the house is completed. And then upon completion, the loan automatically converts to a fixed rate mortgage with no additional closing costs. And we've had several physicians take advantage of that program.
That is really cool because, like you said, there's that just doesn't exist with a lot of programs. It's either a physician loan or a construction loan.
Correct.
And there's generally, I haven't actually seen any institutions that offer like one and the same, a construction perm loan that is a physician loan.
Yep.
And that comes with all the same terms. And I know you can do like 6 month, 9 month, 12 month.
Yeah, all of our construction loans are 12-month terms just because nowadays, depending on availability of product, materials, labor, and all that, all of our construction loans are guaranteed the rate for a year. You lock up front, so there's no uncertainty of what your interest rate is going to be when your house is completed. And we offer that on our
to build that house. You've got 12 months from the date that loan closes up front. You've got 12 months. That's what a 1-year term is you got 12 months to build that house. And you're right. Especially these days, it seems you're going to need every bit of that.
And, for our more seasoned physicians, if they're building a $1 million+ house, we understand it may take longer than that 12 months. And we have programs available for that as well. Our doctor loans, like I said, we offer them in, 3, 5, 7, and 10-1 arms, 30-year fixed, 15-year fixed. But like I said, the most popular for resident physicians are usually the 7-1 arm. And then anybody going, beyond that, once they're an attending, we have a 30-year fixed product that's competitive with conventional rates. But again, you're not paying that PMI and we're not counting your student loans.
Awesome. Well, this has been a great conversation. Thank you so much for your time this afternoon. And we'll go ahead and make sure that there's a link below so that folks can get in contact with you directly. And again, thanks for coming on, and thank you all for watching. And we will contact Emil when you need him.
Thanks for the opportunity.
All right. Take care. Bye-bye.